He did everything right. Spent 40 years contributing to his RRSP every single year without missing one. Maxed his TFSA from the day it was introduced in 2009. Paid off his mortgage early. Never carried credit card debt. Drove the same car for 12 years. He retired at 66 with $680,000 in his RRSP, $95,000 in his TFSA, a workplace pension of $34,000 per year, and full CPP and OAS. He was proud of what he had built. His financial advisor told him he was in excellent shape. His accountant told him he had done everything correctly. His first retirement tax return came back with a notice that his OAS was being clawed back. His second year, his mandatory RRIF withdrawal pushed him into a higher tax bracket than he had ever been in while working. His third year, his total income exceeded $90,997, and he lost $2,400 of his OAS entirely. By year 4, he sat across from me at a financial planning session and said something I have never forgotten. He said, "I saved my entire life so the government could take more of it." He was not wrong. The Canadian tax system has a set of rules that, taken together, function as a penalty on retirement savings above a certain level. None of these rules were designed to be punitive. Each one has a policy rationale. But the combined effect on a retiree who saved diligently is that the more you saved, the higher your tax burden in retirement, the more government benefits you lose, and the larger the tax bill your family faces when you are gone. I spent 28 years inside the Canada Revenue Agency. I have reviewed thousands of retirement tax files, and I can tell you that the people who get hit hardest by these rules are not the wealthy. They are the careful. The ones who followed every piece of conventional financial advice they were ever given. Save as much as you can, contribute to your RRSP every year, let it grow. They did exactly that. And then retirement arrived, and the rules they had never been told about started applying all at once. So let me explain the 5 ways the CRA penalizes Canadian retirees for saving too much, and what you can do about each one before it is too late. Let's start with the most direct and the most widely felt, the OAS clawback. Old age security is paid to every Canadian over 65 who meets the residency requirements. For 2024, the maximum monthly OAS is roughly $713, or about $8,560 per year. It is not means tested when you apply. Rich or modest, everyone gets the same amount. But once your net income exceeds $90,997, the CRA claws it back at 15 cents per dollar above the threshold. Once your income reaches approximately $148,000, your OAS is reduced to zero entirely. Here's the savings penalty hidden inside this rule. The income the CRA uses for the clawback calculation includes your RRIF withdrawals. The very savings you built over 40 years, now being drawn down as mandatory RRIF withdrawals, are what pushes you over the threshold and eliminates the benefit you paid taxes to fund your entire working life. The man I mentioned at the start had a workplace pension of $34,000, CPP of $16,000, OAS of $8,560, and a mandatory RIF minimum withdrawal at age 72 of roughly $36,000 based on his balance. His total income was $94,560. He exceeded the clawback threshold by $3,563. The CRA clawed back $534 of his OAS that year. It grew every year as his mandatory RRIF minimum increased. By age 76, his total income had crossed $100,000, and he was losing over $1,400 of OAS annually. The cruel irony is that if he had saved less, if his RRSP had been $300,000 instead of $680,000, his RRIF minimums would have been lower, his income would have stayed under the threshold, and he would have kept his full OAS. More savings, less government benefit. That is the structure. The strategy to manage it is to draw down your RRSP before converting to a RRIF, using voluntary withdrawals in lower income years to reduce the balance before the mandatory minimums begin. Every $10,000 you voluntarily withdraw from your RRSP between ages 65 and 71, taxed at a lower rate in a lower income year, reduces your future RRIF minimum by roughly $500 to $700 per year permanently. Over 20 years of retirement, that reduction keeps your income lower, protects more of your OAS, and saves tax at every level. Second savings penalty, the GIS elimination. The Guaranteed Income Supplement is paid to lower-income OAS recipients. For 2024, The maximum monthly GIS for a single person is approximately $1,065. Combined with OAS, a single low-income retiree can receive over $21,000 per year in government benefits. But GIS is income tested. It reduces by 50 cents for every dollar of income above a threshold, and it disappears entirely once your income exceeds roughly $21,768 for a single person. Here's the savings penalty. If you saved in an RRSP and you draw it down in retirement, those withdrawals count as income. Even a modest RRSP withdrawal of $15,000 can eliminate your entire GIS entitlement for the following year. A retiree who saved $80,000 in an RRSP, not a wealthy person by any standard, can lose thousands of dollars per year in GIS simply because they drew down those savings. A retiree who saved nothing, who spent everything they earned, qualifies for full GIS. The person who was responsible, who put money away, loses the benefit. The strategy here is sequencing. If you are near the GIS threshold, draw from your TFSA first, not your RRSP. TFSA withdrawals do not count as income for GIS purposes. They are invisible to the calculation. By drawing your TFSA first and leaving your RRSP untouched, you can keep your taxable income low enough to preserve GIS eligibility for as long as possible. Let me show you the math. A woman, call her Susan, age 67, single, CPP of $9,000 and OAS of $8,560. Her total income is $17,560. She qualifies for partial GIS of about $800 per month. She has $60,000 in an RRSP and $40,000 in a TFSA. She needs $15,000 per year to supplement her income. If she draws $15,000 from her RRSP, her income jumps to $32,560. She loses all GIS. She loses $9,600 per year in government benefits to access $15,000 in savings. Her effective tax on the RRSP withdrawal, when the lost GIS is included, is over 70%. If she draws $15,000 from her TFSA instead, her taxable income stays at $17,560. She keeps her GIS. She receives the full $15,000 she needed, plus the $9,600 in GIS she preserved. The choice of which account to draw from first is worth $9,600 per year to Susan. Over 5 years, that is $48,000. The accounts contain the same money. The sequencing determines whether she keeps the government benefit or loses it. Third savings penalty, the bracket creep trap. When you were working, your tax bracket was determined by your employment income alone. In retirement, multiple income sources stack on top of each other and push you into brackets you never expected. Take a retired couple, call them George and Helen. George has a workplace pension of $42,000, CPP of $15,000, OAS of $8,560, and a RIF minimum of $28,000. His total income is $93,560. He is in the second federal tax bracket on a large portion of his income. While he was working, his salary of $78,000 put him partly in the second bracket. In retirement, his income is actually higher than it was while working, despite the fact that he is drawing down savings he already paid tax to accumulate. Helen has CPP of $11,000 and OAS of $8,560. Her total is $19,560, well within the lowest bracket. The strategy is pension income splitting. George can transfer up to 50% of his eligible pension income, his workplace pension, and RRIF income to Helen's return. By moving $35,000 of income to Helen, George's taxable income drops to $58,560. Helen's rises to $54,560. Both are now in the lower bracket. Their combined tax bill drops by over $4,200 per year. They file Form T-1032 with their annual return. It takes 15 minutes. It saves $4,200. Most couples never file it. Fourth savings penalty, the RRSP death tax. This is the one that hits families, not just the retiree. When you die with money remaining in your RRSP or RRIF, the entire balance is included as income on your terminal tax return, the return filed for the year of your death. There is no 50% inclusion rate like capital gains. The full amount is ordinary income, taxed at your marginal rate in the year you die. If you have $300,000 in your RRIF and your other income that year, pension, CPP, OAS, puts you in the top federal bracket. The RRIF could be taxed at a combined federal and provincial rate exceeding 50% in provinces like Ontario or BC. Your family inherits $150,000 from a $300,000 account. Half went to tax. The man who saved $680,000 in his RRSP, the one I mentioned at the start, will die with a substantial RRIF balance unless he draws it down strategically during his lifetime. If that balance is $400,000 at death and his estate is otherwise modest, the terminal tax bill could exceed $200,000. His children will inherit the remainder. The strategy is exactly what I described for the OAS clawback. Draw down the RRSP before the mandatory RRIF conversion at 71, in lower income years, paying tax at a known and manageable rate. Move the after-tax proceeds into the TFSA. When you die, the TFSA passes to your beneficiaries tax-free, no inclusion, no terminal tax. No surprise bill for your family. The RRIF balance shrinks. The TFSA grows. The tax liability transfers from your estate to your TFSA, where it disappears entirely. Fifth savings penalty, the age amount phase-out. The age amount is a non-refundable federal tax credit worth up to $1,318 per year for anyone 65 or older. It is one of the credits I described in a previous video, but here is the savings penalty built into it. The age amount phases out once your net income exceeds $42,335. For every dollar above that threshold, you lose 15 cents of the age amount credit. By the time your income reaches approximately $100,000, the credit is gone entirely. The retiree who saved diligently, whose RRIF withdrawals and pension income push their total above $100,000, receives no age amount credit. The retiree who saved modestly and whose income stays below $42,335 receives the full $1,318. Once again, more savings, less benefit. The strategy here overlaps with everything I have already described. Keep your taxable income as low as possible by drawing from the TFSA first, splitting pension income with your spouse, and managing RRIF withdrawals carefully. Every strategy that reduces your net income on line 23,600 of your tax return simultaneously protects more of your age amount credit. Now let me show you what these 5 penalties look like combined on a single retiree in a single year. The man from the beginning of this video, 40 years of diligent saving, $680,000 RRSP, maxed TFSA, workplace pension, full CPP and OAS. At age 74, his income picture looked like this. Workplace pension $34,000, CPP $16,000, OAS $8,560, RRIF minimum $38,000, total income $96,560, OAS clawback on $5,563 above the threshold equals $834 lost from OAS. Age amount credit fully phased out because income exceeds $100,000. Zero credit. Pension income splitting partially effective but limited because his wife has modest income and the transfer only moves so much. Federal and provincial tax on $96,560 at combined marginal rate approaching 43% on the top portion. He is paying more tax in retirement than he paid in most of his working years, and drawing down savings he already paid tax on once. That is the system. It is not designed to be cruel. The OAS clawback exists to ensure higher income retirees receive less of a needs-based benefit. The GIS income test ensures the supplement goes to those who need it most. The RRSP death tax is simply the deferred tax liability that was always attached to RRSP contributions. But the combined effect on someone who followed every piece of conventional savings advice is a retirement tax burden that surprises and frustrates almost everyone it catches. Here is what I would suggest you do this week. First, calculate your projected retirement income from all sources. Workplace pension, CPP, OAS, RRIF, minimum based on your current RRSP balance and any other income. Add them up. Compare the total to the OAS clawback threshold of $90,997. If you are above it or close to it, you need a drawdown strategy before you turn 71. Second, if you are approaching retirement and your RRSP balance is substantial, start voluntary withdrawals now in lower income years. Pay the tax at today's lower rate and move the proceeds into your TFSA. Third, if your income is near the GIS threshold, check your account sequencing. Draw TFSA first, leave RRSP last. The income calculation difference can be worth thousands per year. Fourth, if you are married and one of you has significantly more pension income, file Form T1032 for pension income splitting with your next tax return. Fifth, talk to a CPA about your RRIF drawdown strategy before you turn 71. The decisions you make in the years between retirement and age 71 determine your mandatory minimum schedule for the rest of your life. Those decisions are reversible now. At 72, when the mandatory minimums begin, they are not. The man who sat across from me and said he had saved his whole life so the government could take more of it was not wrong about the structure. But he was not without options. He still had room to restructure his drawdown, shift money to his TFSA, and split income with his wife. He started doing all of it. The savings penalty does not disappear, but it can be managed, reduced, and in some cases largely avoided. The key is knowing it exists before it catches you. I should say clearly, I am a retired civil servant, not a licensed financial advisor. For your specific situation, consult a CPA who works in retirement tax planning. What I have given you here is the framework, the 5 savings penalties, and the strategies that reduce them. The people who get caught by these rules are not careless. They are the ones who did exactly what they were supposed to do. They just were not told what would happen when retirement arrived and the rules started applying all at once.